What's up, traders? So today I'm going to show you 3 different option strategies that you can use for the upcoming Tesla earnings. And if you have a small account, make sure you stay to the very end because I'll show you a way to do the exact trades that I'm going to talk about, even if you have a very small account. But for those of you new to the channel, my name is Rashad. I am a full-time options trader. I bring in multiple 6 figures a year trading options, and the money I receive from options pays for my entire lifestyle. But enough about that, let's get down to business. Now, Tesla's next earnings is scheduled for October 23rd. And Tesla is already a company that has a ton of implied volatility because the stock price moves a lot. But however, during earnings season, the implied volatility on any stock is much greater because option buyers are placing trades, buying calls and buying puts based on whether they think the stock is going to go up or go down. Well, how can we use that increased implied volatility in order to make money? Now, I will tell you guys, I do not trade earnings as much as I used to because now that I have a much larger account, I like to use safer trading strategies. However, several years ago, trading earnings used to be a large part of my trading style, and I've absolutely had some amazing times. I've had some of my largest gains from trading earnings, including multiple weeks where I made over 15K per week. However, it definitely does come with some risk, so I do want to preference that. But the first option strategy that I'm going to show you is the short iron condor. Now, the benefits of iron condors are the low cash requirements, the limited risk, and consistent income generation. And the objective of an iron condor is to simply generate income from a stock price staying within a specific range. So here's an example of what an iron condor kind of looks like. So let's say we have a stock that is currently priced at $70. And we believe that the stock price is going to stay within a specific range. And for this case, we'll say we believe that the stock is going to stay between $65 and $75. So what we can do is sell to open a $65 put and then buy to open a $60 put. And then on the other side, we can sell to open a $75 call and buy to open an $80 call. And let's say for this example, we received $300 in premium, and the premium received is always going to be your max gain for any option selling strategy. And our max loss will be $500 because there is a $5 difference between our short and our long strikes. All right. So there's a $5 difference between 65 and 60, and there's a $5 difference between 75 and 80. And all option contracts are times by 100. So 5 times 100 is $500. So that would be our max loss. Now, however, in this example, we are receiving $300. So our max loss would technically be that $500 minus the premium we received, which would put us at a $200 max loss. But let's look at the picture here. So like we said, the stock price is currently $70. And we think that it will stay between $65 and $75. Now, as long as the stock price does that, then we keep all of our $300 that we made and we go about our life. However, if it were to go below the $65 strike or above the $75 strike, that is when we will start to see losses on the trade. However, because implied volatility drops so quickly after earnings, as long as the stock price does stay within this range, typically on the next day, you can close out the trade for most of your premium early. So now that we know what short iron condors are, let's now look at what Tesla's expected move after earnings is so that we can now formulate a trade. All right, so if I scroll down here, the earnings is October 23rd, so we would need to select our expiration as October 25th. You want to select the closest expiration right after the earnings. So we would select October 25th as our expiration, and it's currently pricing in a 6.89% move. So that would be $235 on the high side or $204 on the low side. Now, I preferably like to take a more conservative approach to it, so I will pick strikes that are further out than those ranges. So let's head over to Thinkorswim and place a trade. All right, so now I'm over here in Thinkorswim and I have Tesla's options chain pulled up. And the first thing we need to do is select our expiration date, and we already decided that that was October 25th. So I'll open that up. So the data said that we can expect a low move of $204. So I want to select a strike that is well below the $204 mark for our put side. So I would probably come over here and I personally will probably select the 185 strike. And here is why. When I use option selling strategies while trading earnings, I come over to the delta, and the delta is just the probability that the event occurs. So right here is the delta column, and you can see the 185 strike has a delta of 0.04. So that is saying that there is a 4% chance that Tesla's stock price drops down to 185 by this expiration date. Or in other words, we have a 95% probability of profit. So I like that 185 strike for my short put. And so I can just right click there and go down to Iron Condor. And now I need to select my long put strike. Now, this one will determine the amount of money we have at risk, and it will also determine how much money you need for this exact trade. So the closer the strikes are, the less money you have at risk, and the less you'll need for the trade. However, the less money you'll make as well. And the further out the strikes are, the more money you'll need for the trade, the more money you'll have at risk. However, you will make more money when entering into the trade. And I'm going to go with about a $20 width. So I will select 165 for my long put. So I'll come down here, select 165. All right, so now we need to find our call strikes. So I'll scroll down, and calls are always over here on the left side. So let me come over to delta and find a delta of 0.05 or less. So it looks like the highest I would go is this strike of 260, which is well above the $235 of the expected move. But I'll come over to 260 and that looks good to me. So I will select 260 for my short call. And sticking with that $20 width, I'll select 280 for my long call. So now I have my strikes selected, and we can see down here that I will receive anywhere between $67 and $69 per contract. And if we come over here and analyze the trade, so this blue line here is how much we will make or lose at expiration. So you can see here we have our short put at 180 and our short call at 260. So as long as it stays within that range, we will make the full amount. However, if it were to drop below 180, we'll start to lose money. And if it were to go above 260, we would start to lose money. So you can see, depending on your strike selection, you can kind of make as much money as you would like, and you can also limit the amount of risk at your discretion. So that's why iron condors are great. But our second option strategy is, but wait. What if you can make money while on vacation, while spending time with your family without constantly worrying about bills? What if you can make the money for your entire vacation while on vacation? I personally trade options full-time and generate multiple six figures per year, enough to comfortably provide for my wife and 6 kids, and our multiple vacations per year. In Trade to Freedom, I'll show you how to create passive income streams that keep paying even when you're not working. You'll get my exact trades as soon as I answer them. Imagine being able to take that trip you've always been dreaming of, knowing that your money is still working for you. The link is in the description below. I'll see you in the community. Bull put credit spreads. So the objective of a bull put credit spread is to generate income and profit from the stock price staying above your strike price. And many brokerages will call this a vertical spread. So a bull put credit spread is selling a put option with a strike price closer to the money and buying a put option further from the money. So in this example here, we have a stock that is currently priced at $81. So what we could do is sell to open a $73 put and then buy to open a $70 put. And for doing so, let's say we received $100. So that $100 premium that we received is the max that we can get. And because there is a $3 difference between the width of the strikes, a $300 max loss would be our max loss. However, technically you received 100, so you would subtract that from your max loss. So theoretically, your max loss would be $200. But if we look over here, you can see that as long as the stock price stays above the 73, you will make your money and go about your day. However, it is when it drops below 73 that you start to lose money. And the benefits of bull put spreads are very similar to the iron condor. You can create consistent income weekly if you needed to, and it limits your risk. And because the stock market goes up more often than it goes down, I utilize bull put credit spreads nearly every single week. But now let's head back to Thinkorswim and place our trade. Now, if you're doing a bull put credit spread, you are mildly bullish. And assuming that, let's say you want to get a little more aggressive with your strike prices in order to receive more money. Now, as we recall, the expected move was as low as 205. So let's now select something that is just slightly lower than that. So we may come over here and we may select the 195 strike. So I'll come over here, right click, hit sell, hit vertical, and then sticking with that $20 width, I can choose 175 as my long strike. And we can see for placing this trade, we will receive anywhere between $97 and $99 right here, right now. Now, another thing, when you are placing trades on earnings, it's best to wait right before the earnings. So if they are reporting after market, then you will place a trade on that day. And if they are reporting before market, you want to place the trade the day before. But if we go ahead and analyze this trade, and we can see here looking at the blue line, as long as it stays above our 195 strike, we will make our full premium of $97. However, if the stock price were to drop below that, then we start to lose money on that trade. Now, those are two option selling strategies that I utilized very often when I used to trade earnings very frequently. However, what if you are an option buyer and you are okay with a little less probability of profit in order to try to hit a home run? Well, that's when you could do a long straddle. Now, you would place a long straddle if you think the stock price is going to move big in either direction. So the objective is to profit from a large price movement in an underlying asset. In order to place this trade, you essentially buy a call and buy a put at the same strike. So we can see in this example here, let's say Apple is currently trading at $175 and it's about to have earnings, and you think that the stock price is going to move big after earnings. Well, what you can do is go ahead and buy a call and a put at $175 each, and your max loss for this will be whatever you paid to enter into the trade. So since this is a buying strategy, you are paying to get into the trade instead of being paid. Now, I personally rather be paid, which is why I sell options 99% of the time. However, I have used this strategy a few times, and when it works, it really, really works. So in this example here, you paid $200 to get into the trade, and that would be your max loss. And then your max gain would theoretically be unlimited because a stock price could go up to infinity theoretically. So heading back into Thinkorswim, this is how this would work. So the stock price, Tesla stock price is currently $219. So you would just select the closest strike. So let's say it's $220. So we'll buy both a put and a call at $220. So hit buy, hit straddle, and this is how this would look. You would be paying anywhere between $1,760 and $1,770 to enter into the trade. And from there, you're just hoping that Tesla's stock price moves big in either direction. You don't really care which way it goes. You just want it to move big either way. But however, if it doesn't, then you can lose that entire $1,700 that you placed for the trade. In analyzing the trade, you can kind of see here that, yes, if it does move big, you will make a whole lot of money. Just looking at this now, let's say Tesla goes up to like $280 afterwards, you will make about $4,000 per contract. So that's a way to hit a grand slam if you were to try it. However, what if you have a really small account and don't have the money to trade Tesla in any of the three ways that we just showed? Well, that's where leveraged ETFs come in. So really quickly, a leveraged ETF is just a fund that aims to deliver multiples of the performance of a specific index or stock. So a leveraged ETF that follows Tesla would look to move 2 or 3 times the amount that Tesla moves for the day. So if Tesla is up 1%, a leveraged ETF would be up 2% or 3% for the day. And the same works in reverse. If Tesla is down 1%, then a leveraged ETF would look to be down 2% or 3% for the day. Now, because of that added volatility, you get even more premium when trading these stocks. But however, it works great for people with smaller account because leveraged ETFs are typically a much cheaper price than their stock or index counterparts. And a leveraged ETF that follows Tesla that I also trade very often is ticker symbol TSLL. Now, as you can see here, TSLL is only $9.54 currently. So because the stock price is so cheap, it makes it a lot easier for people with small accounts to trade it. So let's head over to Thinkorswim and look at possibly trading TSLL instead of Tesla. All right, so I now have TSLL put up on the options chain, and I have our same exact expiration of October 25th. And we know that the stock price is currently at $9.55. So I'll come over here and let's say we want to place an iron condor, and I'm looking at the $8.50 strike for my put. So I'll right click, hit sell, iron condor. And let's say in this case, you only want to risk $200 per contract. Well, in that case, we just need to select a strike that is just $2 away from our short strike. So our short strike is $8.50. So I'll select $6.50 as my long strike. Oops, let me go back over here, $6.50. And now we need to select our calls. So let's say we want to go with the $11 strike for the short call. So come over here, select 11, and then sticking with that $2 width, we'll select 13 for the long call. You can see here we'll receive anywhere from $40 to $43 per contract. And if we analyze the trade, you can see here, as long as it stays within our strikes, then we'll receive the entire $43 per contract. However, if not, then we'll lose the $200 minus the premium received. So that is just $157 at risk for this trade. So that is a way for people with really small accounts to trade Tesla's earnings. But guys, I hope you liked all the information that you received today. If you would like to learn more from me, please come join the Trade to Freedom community. You'll get to see my exact trades and get my entire options framework and have access to me 24/7. The link is in the description below. I hope to see you guys there. But until the next video, peace.